Hi everyone. So while I was thinking of obviously popular stocks where I like the structure of the stability of them and their general uptrending or increase in value, whether it's perceived value or not, but it's definitely there in terms of return to shareholders. It occurred to me that I should at the same time counterbalance that with examples of what, and again, it will obviously potentially be offensive to some people or controversial, but these will be kind of obviously these will be technical stocks that to me are well known and popular for people to potentially try to kind of own. They're not looking to trade them, they're looking to physically own them and invest in them. And these are ones that, as far as I'm concerned, are incredibly bad investments, and certainly for, I guess, for the foreseeable future. Foreseeable future meaning the next few years. So I really don't see any value there. So I'm going to start off. I've got both US and UK. I've got a couple out of the US. I'm going to go have a look. And I'm going to start off with Vodafone. Okay, so Vodafone out of the US actually had its peak in February 2014. And it has been, since then, it has been in a relatively strong downtrend. Now, it is worthwhile mentioning that it looks like as though it's pretty much going to flatten out here, meaning that it's based off these indications here is likely to find a base at around about 1,500. Okay, which means for me, I won't see much more value until it subsequently breaks back up above this high here, which we'll put at 2,120. So it's got to break above that for me to reconsider it, which is also a support level. Okay, so it's got to get back up above that for me to start to see value, and that could take a while. It could take several months to a couple of years for it to do that, and it's still currently in a downtrend, and therefore not really going to return much value. And the biggest issue is that it's principally in a downtrend, which means that its value currently is heading lower and hasn't actually even stabilized. So it still has to stabilize, then it would have to change trend before I would consider looking to buy it. The second one on my list is the Kraft or Heinz company. Okay, and they've pretty much bottomed out. They are almost certainly going to level out where they are here. So I'll be looking for them to break the high of November 2019, which puts them at 3,247.5. At which point it would potentially start to climb up from that. Okay, but it's currently at least has flattened out. So that's most likely the lowest it's going to go for now. But it's not great in terms of value that it's returned to people. And based off its history, I'm interested to see. It doesn't necessarily even mean it's going to climb very much. It might just sort of waffle around that area. It's not great for value. The next one, so now I'm going to go into the UK stocks, and these are ones that I've heard at at the water cooler, around the table, and these are for some reason are perceived to be valuable to buy at discount prices, with the idea being that over the next few years they will return good value to the shareholders. The problem I have is that most of these, or many of these, have a long history or several years worth of terrible performance history in terms of value on their shares. And so I'm going to start off with Glencoe. So Glencoe is very popular. It bottomed out originally around 2015, managed a bit of a recovery, found a ceiling at about 340, 350, and has subsequently headed back down towards these lows. So there's a nice kind of level support around about 75, call it 75. Price is very much in a downtrend, and it does not show any signs, is not showing any signs of stalling or changing that. So I suspect its best shot is to head up to 200 and then potentially to head back down, and at that point probably down towards 75 over the next year or so. So that is, I don't see any point in buying this because it's not increasing in value. And so my issue is buying something because it's cheap is not the same as buying something that is uptrending in value, that has taken a correction in price and therefore I'm able to get into an increase in value over time. This is showing a demonstrable decrease in value over time. And the trend is nice and healthy. In other words, it's nice and bearish, and it's not even entering. This oversold thing is not really accurate. this indicates, if anything, that it's nice and bearish, and looking at price, there's no divergence. So I would need to see it really reject a level, and that's not going to happen for the next few months. So I wouldn't, these are things that I absolutely would not be putting my money into at this point in time. There are so many better options out there. Centrica, another one, very strong downtrend, is starting to bottom out, but hasn't really got there yet. So potentially I take another run at those lows before starting to bottom out, but no change in that, and no perceived. I mean, the point is that for the next 10 years, this could hover around this price level. So just because, as I said, it's heading and it's very cheap, there's no rational evidence to support the idea that this is going to increase in value, and therefore buying it's cheap. Keep in mind that a stock can devalue so much that it could go to zero and then just be delisted. So if you think that buying something cheap is the way that we're going to guarantee some kind of a return on it, because it can only go up from here, kind of rational, it's not at all. It can go down and just be pulled. So that can just be a money loser. Vodafone is another one. Okay, so Vodafone here is still downtrending. It is sitting at a level support at 100. It's flattening out over here at this point in time, but at the same time, it isn't demonstrating, and it hasn't demonstrated historical. And this is going all the way back to 2002, and it's at its peak. It was 2000. It really hasn't demonstrated value for shareholders, in my opinion. And so I just can't see anything here that's going to show a trend of increasing in value. BP is generally a range-bound one. It bumps between these low levels and highs. So yes, the potential is that it could be climbing up to the top. But in this case, if I was looking to add to my pension, I have to keep in mind that when it heads up to these highs, I should realistically consider exiting my position at that point, because in probabilities, it's likely to head lower again and just ping pong between these levels. It's just not a great one. There's no real, resounding reason to do it. Carnival's broken all of these lows, so even broken the lows of 2008. It's very much overextended, so it's likely to have a bit of a bounce, probably up to 2000. And I suspect potentially struggle to get beyond that. At best, 2,500, but I think 2,000 is going to be its best. And then I think we're likely to see it continue to head lower. It's nice and bearish, nice and healthy trend. Just terrible value for that land security group. Mainly, this is on my list because it's just done nothing for a very long time. Again, they peaked just before the global financial crisis. And they really haven't gone anywhere. They're just sitting at lows, and so there's no value here at this. I want something that is has shown historically that it can climb, and this isn't really performing on that. Royal Dutch. Okay, so Royal Dutch Shell, similar to BP, is pretty much sitting at its bottom now. Not performing very well. You can see it's taken a hit in the last few months. And again, it shows, if nothing else, that it is not its foundation is prone, has a vulnerability. And so again, this is something that for the longer term, next few years, I can't really see. If I have if somebody says to me, look, you can only pick 20 stocks, these are just not going to be in those 20 stocks. HSBC, again, it's a popular brand. People like to buy into the banks they have accounts with, but HSBC has shown that it just can't seem to really break and hold and stay above 600. It really hasn't been able to do that much going back to 2008. So there's no significant change in its value at this point, and it's sitting at the lows. Kingfisher has obviously just been steadily losing value and is still hovering around its lows, and this is kind of the area where it's likely to stay at 4 now, showing a bit of a climb, so it looks like it's bottoming out a little bit here. But again, my saying that it's bottoming out does not mean it's an opportunity, I don't think, to buy. I have to see a trend, an uptrend, actually start to form before I start to do that. BT, so again, these are really big popular brands. BT is terrible in terms of value, in terms of its shares. So if I wanted to tell people that I own shares of a big brand so that I can feel great about myself, then sure, BT would be that. But if I might as well at that point just, I guess, burn the money, because it's not really going anywhere. Aviva, Aviva's also a well-known brand, same thing, very similar to a lot of the others. They've all taken Knox. So a lot of these were obviously not that strong to begin with because they've all taken Knox in the last 3 or 4 months. It's sitting at its lows, and there's always going to be buyers at these levels, but the problem is there's just no value. And I think these are the kind of things where, if you get something like a boiler room operation that's trying to offload penny stocks or trying to offload this will be the kind of stuff that sits on their list, because it's a well-known brand. It's obviously very cheap, and so it'll be the idea of kind of giving someone access to something like this. But there ultimately will be no real return on value or return, I guess, to shareholder value for them. So it's frustrating. Standard Chartered, okay, another one, rock bottom. It doesn't even look like it's finished yet. It looks like that could still potentially head lower. Lloyds. These are all big names, and this has got nothing. I mean, Lloyds has just never really recovered going from 2000. Presumably, I don't really know what they're doing with in terms of their what their plan is, but they don't seem to be demonstrating anything here, which is amazing when you compare them to Visas and MasterCards that are thriving. And even Amex is taking a bit of a hit, and that's presumably they've got with their credit cards potentially they're carrying a lot of debt, and so they were one of the few companies that was pushing big credit cards onto individuals even after the 2009 global financial crisis. So potentially that's one of the reasons they've taken a bigger hit. But MasterCard and Visa are rock solid. Lloyds is just shockingly worthless. So again, these are all big brand names: HSBC, Lloyds, Vodafone, Glencoe, very popular, and for want of a better word, are crap, and big names. But just in terms of, this is not a reflection on the company's services, and maybe it's I guess what it provides to its customers, but in terms of the value of owning its stock. EasyJet. Okay, so we all know that all the airlines are taking a hit now. EasyJet is just unable to get past that 1400 and is heading a little bit lower, so just pointing that up. Pockys. Again, I mean, I've got Barclays bank accounts as well, and they're big on their business, but inherently you can see here, they are just unable to climb beyond it. The sellers are very much people are exiting at any opportunity they can get, and so it is just ranging at about this level. So value appears to be at about that $100 option, and so that's another kind of useless one. And these are ones that if I owned them and I wasn't bothered either way, I guess I'd hold on to it, but I wouldn't realistically expect them to achieve much value over the next 5 years. And certainly if I did own them, I would consider the idea of just getting rid of them before they get, if they potentially get worse. Associated British Foods. So the reason I'm bringing this up is because of these stronger lower highs and lower lows, and we had a spike down, and even so it's currently starting to head lower. So this is inherently weak. It's inherently weak, and its potential to go back down towards 1,000 is pretty real, somewhere between 1,500 and 1,000. That doesn't show much brightness in its future, and especially because it seems to have peaked around 2015, and so far not looking good. Sainsburys. So Sainsburys heading lower even as we speak today. It's starting to push down to test those lows. Okay, it's still got some room to go lower. I see it heading towards 150 and heading down towards 150 down towards 100. So it's broken through this level of support, and it's pushing through even as we speak now. So that the future for that looks pretty bleak. Rolls-Royce. Everybody knows the brand Rolls-Royce, but you can just see here they kind of peaked around 2014. Potentially that's because they weren't really invested too much into, obviously, and they've got, if I recall correctly, they own BMW. I'm trying to think now there's a relationship there, I forget. I could be wrong, of course, about that. But yeah, definitely losing value. Strong downtrend starting to head towards these lows at 200. So 200 will be a level for them. They're a bit overextended, potentially a bounce back up, and then potentially heading a bit lower. We'll see about that. 200 might be able to hold, but not showing going back for the last 6 years, not seeing much of a trend there. And if you look, they took a little bit of a hit over the global financial crisis, then they managed to recover and do really well, then they dropped, then they failed to recover, and then they've dropped further. So whatever's going on there, it's not good. ITV, obviously massive, but you can see again, starting around about 2015, they've been losing value. I don't really see 50, potentially I don't really see 50 holding. I would see more towards 38 and then potentially lower down, but I might even be able to bounce back up towards these lows here and then head lower. doesn't look great. So ITV not looking good. British Land as well, sitting at its lows. So not much value there. And last of all, Taylor Wimpey. This one is drifting sideways and potentially upwards. But if you just look at its kind of performance since through the GFC, not very good. And then a very kind of a lackluster recovery. So pretty much going to stay in this area for the next few years of its lifetime, unless something changes. So these are already, this is a list, as I said, it could be controversial, but these are all what I would consider, despite their history, and despite how well known some of the names are, there is a lot of evidence to indicate that they are currently severely underperforming and have a greater probability of losing more value in the coming years, and are the least popular. If I had, as I said, it's there's how many of that are there? Somewhere 21 of them, 21 of them that are I basically wouldn't touch with a 10-foot barge pole. So there we go. Again, please give me your feedback if you want to defend them, go for it. I'm interested in fundamental opinions as well, but yeah, I'd love to hear your feedback on that.